You know that feeling, right? Prices are ticking up, and you start thinking, hang on, are my savings actually shrinking? It's that inflation worry.
Yeah, it's a real concern for most people. But then you look at, well, the very wealthy, and sometimes it seems like they're navigating these choppy waters a bit more smoothly.
Exactly. It's quite the contrast. While many are struggling with purchasing power, there's this group of, let's say, sophisticated investors who are increasingly turning to something specific. Bitcoin.
Bitcoin, yeah,
Yeah,
it's definitely an asset that stirs up conversation. Lots of volatility talk usually.
right. But we're going to dive deep today into why the wealthy are strategically using Bitcoin, specifically thinking about it as a tool to protect, maybe even grow their wealth when inflation is high.
And the big question, I suppose, for anyone listening is, okay, that's them, but what does this mean for me?
Exactly. That's our mission for this deep dive. We want to unpack why this group trusts Bitcoin as an inflation hedge, how their approach might be different from, say, the average retail investor.
What advantages they might have, what they're actually doing.
Yeah, and pull out some real insights that maybe regular investors can learn from. We've looked at institutional surveys, hedge fund reports, academic work, lots to dig into.
Okay, so let's start at the beginning. Why Bitcoin? Why are wealthy investors looking at this particular asset when they're worried about inflation eroding their fortunes?
What's the core appeal?
Well, I think the first and maybe most crucial point is scarcity. It sounds simple, but it's fundamental.
Scarcity, like digital gold, people sometimes say.
Sort of, yeah. Unlike the money we use every day, dollars, euros, where central banks can decide to print more.
Which can lead to inflation.
Exactly. Bitcoin has a built-in hard limit. There will only ever be 21 million Bitcoin, period. That's written into its code.
So you can't just decide to make more Bitcoin tomorrow because the economy needs a boost or something?
Nope. It's a fixed supply. And there's another clever part. Even if more people try to mine new Bitcoin, the system automatically makes it harder to do so.
Ah, the difficulty adjustment. I remember reading about that.
That's the one. Analysts like Lynn Alden, folks at Fidelity Digital Assets, they point this out. More mining power comes online. The system just ups the challenge.
So it keeps the rate of new Bitcoin entering the system pretty steady, regardless of effort. Around 10 minutes per block, right?
Roughly, yeah. It regulates the supply automatically. So that finite nature, that controlled issuance, is a massive contrast to traditional currencies.
Okay, scarcity is point one, a big one. What else makes it attractive as this inflation hedge?
The second point, closely related, is decentralization.
Meaning no single boss, no central bank, no government pulling the strings.
Precisely. It operates on a network distributed across thousands of computers worldwide. There isn't one entity you can point to and say they control Bitcoin.
So it's potentially resistant to, say, a government deciding on a monetary policy that might devalue the currency.
That's the idea. Fidelity mentions this. You see it discussed on places like Reddit, too. This lack of central control is seen as a safeguard against the kind of policy decisions that can fuel inflation.
It exists outside that traditional power structure, which is quite radical, really, compared to how finance usually works.
It really is.
Yeah.
And that leads into this idea of Bitcoin becoming, or at least having the potential to become, a digital store of value.
An aspirational store of value, I think Fidelity called it.
Yeah, aspirational is a good word. The concept is if enough people and institutions come to see it as a reliable way to preserve wealth, especially when fiat currencies are losing value,
Then demand increases, and with that fixed supply.
you potentially get significant value appreciation. It offers protection against monetary debasement, plus what they call asymmetric upside, the potential for big gains if it really takes off in this role.
We've even heard some pretty big names in traditional finance start talking about it this way, haven't we?
Absolutely. Someone like Larry Fink, CEO of BlackRock, a giant in traditional asset management, suggesting institutional investors might look at a, say, 5% allocation to Bitcoin as an inflation hedge. That's a significant statement.
It really signals a shift, doesn't it? Away from just fringe speculation towards something more strategic.
Definitely. And then there's the performance aspect. You can't ignore it.
How it's actually done compared to other things.
Right. If you look back over the last, say, 3 years, and this gets talked about a lot in investor communities online, Bitcoin has significantly outperformed traditional hedges like gold and even major stock indexes.
Okay, so let's recap the why. Scarcity baked in, decentralized control, this growing idea of it as a digital store of value, and, well, pretty strong historical performance recently.
Those are the key pillars, I'd say.
So it starts to make sense why wealthy investors are looking seriously at it, but how are they doing it? Is their approach different from, someone just downloading an app and buying a bit?
Oh, absolutely. That's a really crucial distinction. For most wealthy investors, Bitcoin isn't usually a standalone gamble. It's typically seen as one piece of a larger puzzle.
Part of a diversified portfolio.
Exactly. They're strategically allocating a certain percentage to Bitcoin alongside their stocks, bonds, real estate, other alternative investments. It's about adding a non-correlated asset for diversification benefits. That's just sound portfolio management.
So not betting the farm, but adding a specific ingredient for a specific purpose?
Precisely. And crucially, they often come at it with a very different time frame in mind.
Longer term.
Much longer term, generally. While a retail investor might see a price dip and panic sell or get caught up in short-term hype.
Yeah, the emotional roller coaster.
Right. Wealthier investors, or at least their advisors, are often positioned to view those dips, especially maybe during periods like interest rate hikes that cause market jitters, as buying opportunities.
Accumulating more when it's cheaper, with the conviction it'll pay off down the road.
Exactly. There's that old saying, right, that millionaires are often born during market downturns because they have the capital and the nerve to buy when others are fearful. That long-term perspective is key.
Makes sense. Are they also using different ways to actually get that Bitcoin exposure, different tools?
Yes, that's another difference. While retail might use public exchanges, institutional investors and high net worth individuals often access Bitcoin through different vehicles.
Like what?
Private crypto funds are quite common. That 2025 Institutional Investor Digital Asset Survey highlighted this. It's a frequent route for them.
So more like investing in a managed fund that holds crypto rather than holding the keys themselves necessarily.
Often, yes.
Yeah.
It can offer a more structured approach, potentially manage risk, reporting they're used to. It fits better into their existing operational frameworks.
Okay. And are we seeing just more interest overall from these big players?
Definitely. That PwC Crypto Hedge Fund report, I think it was the 6th annual one, found that something like 2/3 of the hedge fund managers they surveyed noted increasing institutional interest in digital assets.
So it's not just a few pioneers anymore. It's becoming more mainstream within those circles.
It seems to be heading that way. The conversation is shifting.
And are they just buying and holding Bitcoin or exploring other things in the crypto space too?
That's another interesting point. That same institutional survey showed over half are interested in tokenized assets.
Tokenized assets, like putting real-world things onto a blockchain.
Or tokenizing existing funds, like alternative funds. They see it as another way to diversify, using the technology for different kinds of assets. It shows a deeper, more sophisticated engagement than just buying Bitcoin.
Okay, so they're looking beyond just Bitcoin itself into the wider ecosystem. That leads me to wonder, what specific advantages do wealthier investors have when they operate in this space?
Well, one area is their growing engagement with DeFi, decentralized finance, and also how they use stablecoins.
DeFi. That's the whole world of lending, borrowing, trading on the blockchain without traditional banks.
In essence, yes. The survey we mentioned found a noticeable chunk are already using stablecoins. Those crypto tokens pegged to things like the US dollar for yield generation, easier transactions, even foreign exchange.
They're generating yield.
Yeah.
Like earning interest, but in the crypto world.
Kind of, yeah. Through various DeFi protocols. And the survey predicted that the percentage of these investors involved in DeFi is set to basically triple in the next couple of years.
Wow, triple. So they're actively moving into these more complex areas.
It seems so. They have the resources, perhaps the risk tolerance, and dedicated teams to explore and vet these newer protocols and strategies.
And are their trading strategies different too?
It appears so. While the report didn't single out the wealthy specifically, it did note that digital asset hedge funds often use strategies you don't see as much in traditional hedge funds, things like market neutral or quantitative long-short.
Strategies designed to make money regardless of whether the market goes up or down, or using complex algorithms.
Potentially, yes. It implies a more active, maybe more complex management style than just buying and holding. Again, this often requires specialized skills and tools that aren't accessible to everyone.
More sophisticated ways to play the market, basically.
Possibly. And then there's the less tangible advantage, which is probably just better access.
Access to what? Information. Deals.
Both, potentially. Larger players, institutional investors, they just have bigger networks, more resources for research, maybe earlier insights into market shifts or new projects. It's not explicit in the data, but it's a reasonable inference in most financial markets.
So the smart money advantage, perhaps. Okay, can we talk about some concrete examples? Where do we see this institutional adoption actually happening?
A really clear recent example is the approval of spot Bitcoin ETFs in the US.
Right, the exchange-traded funds that directly hold Bitcoin.
Exactly. That PwC report mentioned earlier specifically said that this development has really changed the perspective for many hedge funds. They're now more positive about launching their own digital asset products.
So the ETFs provided a kind of regulated, familiar on-ramp for them, made it easier to get involved.
It seems that way. It
Yeah.
lowers the operational hurdles and provides a structure they understand.
And what about the core reason inflation? Do we see evidence of that driving investment?
There's interesting research, actually. An NBER working paper looked at India and found a direct link between households' expectations about future inflation and their likelihood of buying cryptocurrencies, particularly Bitcoin.
So when people get worried about inflation, they start looking at Bitcoin more seriously?
That's what the data suggested for that group. Now, that was households, not necessarily the super wealthy, but it highlights the underlying motivation. The fear of currency devaluation is a real driver pushing people towards assets like Bitcoin.
It shows the fundamental psychology at play.
Indeed. And then you have influential investors like Paul Tudor Jones, who've been quite public about it. He's talked about holding both Bitcoin and gold precisely to fight inflation.
Endorsements like that probably carry weight too.
They definitely add to the narrative and can encourage others, both institutional and individual, to take a closer look. It helps legitimize it as more than just speculation.
Okay, this paints a pretty clear picture. We've got the why scarcity, decentralization, store of value potential. We've got the how diversification, long-term view, different vehicles like funds, exploring DeFi, and the advantages may be better access, more sophisticated strategies. So pulling this all together, what are the key takeaways for a regular investor listening to this?
Right, because not everyone has access to private crypto funds or DeFi quants. But the core ideas are still relevant.
What's takeaway number one?
First, maybe consider the principle behind why they hold it. Bitcoin as a potential long-term hedge. Acknowledge the volatility. Yes, it's not a smooth ride. But those fundamentals, the scarcity, the decentralization that attract the wealthy could, over the long haul, offer some protection against purchasing power erosion for anyone.
So think long-term, understand the why beyond just the price chart.
Exactly. Which leads to the second point. Focus on understanding the fundamentals.
Know what you own, basically.
Yes. Understand the technology, grasp the concept of the fixed supply, why decentralization matters. Don't just chase price swings based on headlines or tweets. Deeper understanding usually leads to better decision-making, especially when markets get choppy.
Less panic selling if you actually believe in the underlying assets' properties.
Precisely. Third, while maybe not diving headfirst into complex DeFi tomorrow, be aware that the space is evolving. Wealthy investors are exploring stablecoins for yield, looking at tokenization. It suggests there's more to crypto than just Bitcoin speculation.
So maybe explore cautiously. Do your homework.
Absolutely. Explore, learn, but be very aware of the risks. Due diligence is critical in these newer, less regulated areas. It's not advice to jump in, but rather to be aware of the trends the sophisticated players are following.
Okay, and the last insight.
It loops back to the long-term perspective. Try to cultivate that patience. Learn from the wealthy approach of potentially seeing dips, not as disasters, but as part of the journey, maybe even opportunities if your conviction holds. Avoiding those emotional knee-jerk reactions to volatility is crucial.
Easier said than done sometimes, but definitely valuable advice. Okay, great insights. So let's quickly summarize. The wealthy are increasingly looking at Bitcoin not just as a punt, but as a strategic piece in their financial toolkit, specifically to counter inflation.
Right, driven by its unique features like fixed supply and decentralization, and its potential as this new kind of digital store of value.
And their methods often differ. It's part of a diversified plan. They think longer term. They might use special funds or explore advanced areas like DeFi.
And regular investors can learn from that focus on fundamentals, think long term, understand the why, and be cautious but aware of the evolving landscape.
Perfect. Which brings us to our final thought for everyone tuning in.
Given everything we've discussed, how the wealthy are using Bitcoin's core principles like scarcity and decentralization to potentially hedge against inflation, how might those same principles inform your thinking about protecting your own financial future?
In this constantly changing economy, what further questions does this raise for you about where digital assets might fit or not fit in a modern portfolio? Something to think about.